talk to me about the 4% rule, the historical nature of that playing into FI, and then whether you think that exists or if it doesn't exist, why doesn't it exist anymore?
Yeah, the 4% rule is a pretty well-known metric for identifying that point where you have reached financial independence, that point where your portfolio can support the expenses that you have. And the way that it works is that you take whatever your annual expenses are and you divide by 4%, which calculates to some number of a couple of million for most people for how big your portfolio needs to be to support that spending. So what this comes out to is for every, what is this, $40,000 of expenses that you need or that you have, you need $1 million worth of a portfolio to support it. And you can draw down 4% on that 1 million to cover your $40,000. So the inverse of this calculation of dividing by 4% is just multiply your expenses times 25x. So when you reach 25 times your annual expenses, you are financially independent. Your portfolio can support you in all of your expenses. And you do that by drawing down on it, by selling 4% of that portfolio, those assets over time. And historically speaking, the way this has worked out is that you never run out of money over at least a 30-year time horizon, but even a lot further. And in fact, in most of the cases, historically speaking, you would end up with a lot more money than what you actually started with because of the compounding nature of that portfolio. And so this is what I was saying earlier, where your balance sheet actually is so much more powerful for you than your income statement, than the revenue that you're bringing in from your job, your income, because at a certain point, it starts to generate much more wealth than you could ever do by just working a job, by having an income. And so that's what I mean when I say that your job is really to take that income and to buy assets that will compound in a way that that frees you from having to have the job in the first place. The 4% rule came from something called the Trinity study, which was done back in the 90s and was looking at over 100 years of stock and bond market data. And it was basically testing like what is the appropriate amount of assets that are needed to support a lifestyle. You can go look this up, but the long story short is that's where the 4% rule came from. Well, how does this apply to Bitcoin? Well, the 4% rule was based on a mix of stocks and bonds, and Bitcoin grows a lot faster than stocks and bonds. And I expect that that will happen over a very long time horizon. Will it grow as fast as it has, historically speaking, in the first 15 years? Probably not, right? Rule of large numbers. But that doesn't mean that it's going to slow down to the rate of the stock market at, call it 10% per year. It's probably going to grow faster than that because it's perfectly fixed in supply and because it's undergoing an adoption cycle right now that is probably going to last for another 10 or 20 years until we start to reach the upper part of that S-curve adoption. And so what that means is that the compounding rate that you have when you own Bitcoin is going to be a lot higher than, call it 10% in the stock market, which also means that you can draw down on a portfolio of Bitcoin at a higher rate than 4%. So I wrote something in my newsletter that asked this question, is the 4% relevant to Bitcoin? I think it is, although it might be more like 5, 6, 8%, 10%, something like that, in order to still be conservative, but be able to live off your Bitcoin. What that also means in terms of the amount that you need to save is that it's a lower threshold there, right? If you divide by 10% instead of 4%, well, now all of a sudden you need a whole lot less in that portfolio in order to be able to sustainably live off of that compounding that is happening there. So that's how the 4% rule works. I still actually use it, and I don't know. I have a lot of like probably interesting takes to people around things like emergency funds and mortgages and all this kind of thing. But when it comes to like just my own peace of mind, which is another thing that I kind of make fun of people, poke fun of people with. I like to just be conservative. So I still use that 4% rule, even though the vast majority of my portfolio of assets is Bitcoin, and it's growing at a much higher rate than the 9-10% that's out there.
That was a really great explanation of the 4% rule. And I'm glad that I asked you because I was going to try to do it. And I'm like, no, I'm just going to serve this up to Trey and let him try. The reason why I ask you is a couple of things. One, yes, you've touched on it, right? Bitcoin is going to be a vehicle that's going to grow faster historically. Even if it slows down from the first 15 years, it's still going to be, orders of magnitude greater than what the stock market should return. And knowing that, I also wanted to there's the other side, which is the fact that with inflation and currency debasement, I think you're going to just need more dollars to get more things in the future. So I wonder how that plays a role in your thinking. And then when you sit down with people and you talk to them about these things, and when you write about it, does the 4% rule still work? How does currency debasement and inflation play a part in your thinking?
Yeah, so actually the Trinity study takes inflation into account. Now, does it use the proper metric for inflation? Probably not. We kind of all know that inflation is not what CPI is. It is much higher than that. It's probably closer to 7-8% on average, which is right around where the M2 money supply grows on an annual basis. And you can see this in things around you, right? Like you go to the grocery store, sorry, but your eggs are not growing at a measly 2 to 3% in price. They're growing a lot faster than that. And same thing for healthcare and education and, the cost of living in, certain parts of the country is going up a whole lot faster than the 3% CPI readings that we've been seeing. The Trinity study and the 4% rule does take into account at least some portion of that inflation that is there. And the reality of the situation is that forget about Bitcoin for now. If you're just using stocks as your asset of choice and you are following a FIRE framework, those stocks are going to grow at a faster rate when there is more inflation, just because the value of the stocks are very closely tied to the amount of money that is out there, to the growth in inflation, and it's going to reflect that. So you don't necessarily need to take that into account. It's already kind of baked into the calculation that is part of the 4% rule.